Markets rise and fall. That basic fact lies behind everything Graham wants you to understand in this chapter. If most of your money sits in short-term, high-grade bonds, the daily noise won't bother you much. But if you own long bonds or common stocks, wide price swings are part of the deal. The question isn't whether prices will move. They will. It's how you respond when they do. Graham draws a helpful distinction between two ways investors try to profit from those swings. One is timing, trying to guess when the market will go up or down and moving in and out accordingly. The other is pricing, estimating the true value of a business and buying when the market price is below that value, selling when it is above. Timing sounds glamorous, pricing is boring, but Graham's point is simple and hard. Timing is speculation, pricing is investing. Most people who chase forecasts end up acting like speculators without admitting it. Why is timing such a trap? For two reasons. First, forecasts and trading formulas often look great in hindsight. A strategy that would have turned $1 into $10 over the past century will be peddled as a miracle, and a lot of people will adopt it right when its edge disappears. Popularity changes market behavior. Second, timing demands short-term success, and the pressure to be correct now leads investors to buy into rallies and panic sell into drops. Those are the mistakes that compound damage over time. That's where Graham's most famous metaphor enters the scene, Mr. Market. Picture a business partner who appears each day with an offer to buy your stake or to sell you a bigger one. Some days he is exuberant, offering ridiculously high prices. Other days he is morose, willing to dump your shares for less than they're worth. Mr. Market is helpful if you treat him as a source of prices to be transacted with when his price benefits you, but disastrous if you let him decide how you feel or what you do. Modern examples make Mr. Market painfully vivid. In the dot-com boom, a small company like Inc2Me could trade at hundreds of dollars a share and carry a multi-billion-dollar valuation, even though it had never recorded an annual profit. A couple of years later, the mood flipped. The same shares sold for pennies. The underlying business had not vanished overnight. What changed was the market's collective mood. That manic swing produced spectacular winners and horrifying losers, and it shows why relying on market sentiment is a poor way to invest. Understanding how your brain reacts helps explain why that happens. Our brains are wired to see patterns and reward short streaks. A few good days trigger dopamine. We feel right, confident, and eager to keep riding the trend. By contrast, losses light up the fear centers and produce an urge to flee. Behavioral research tells us that the pain of losses usually outweighs the pleasure of gains. That imbalance makes many investors sell in a panic at the bottom or miss the rebound, exactly the opposite of what a rational long-term plan would dictate. So what should you actually do when prices swing? Graham's advice is both practical and psychologically savvy. First, decide whether you are an investor or a speculator. If you want to speculate, do it explicitly, with money you can afford to lose, and keep it separate from your investment capital. If you are an investor, accept that market prices will vary and let those variations create opportunities rather than anxieties. A good example, A&P, the grocery chain Graham recounts. In 1938, at a terrifying shop-worn bottom, the company's shares were trading for less than the cash and working capital on its balance sheet, effectively the market valuing the operating business at less than liquidation. An investor who had confidence in the company's underlying business could buy at that low price and later be richly rewarded when the market corrected. But A&P's story also warns that businesses change. By the 1960s, the same company was wildly overpriced and eventually delivered disappointing returns. The lesson here is twofold. Market prices can be foolishly low or irrationally high, and owning a business requires occasional re-examination of whether the underlying fundamentals have changed. That leads to a practical habit that is not glamorous but works. Form a view of a business based on its financial reports and a sensible appraisal of future earnings. Then use market prices as the chance to act when those prices make the math attractive. When prices are elevated because the market is euphoric, you don't have to sell everything, but you should at least resist the herd instinct. When prices fall and you still like the underlying business, consider adding to your position. In other words, treat the market as a tool that offers bargains and opportunities, not as an oracle you must obey. You can make this easier on yourself by automating discipline. Regular automatic investing, dollar cost averaging into a broadly diversified vehicle like a total market index fund, removes timing pressure and lets you buy more when prices are down and less when they are high, without drama. Rebalancing periodically does the same thing in reverse. When stock allocations run high, you trim. When they fall, you buy. Both practices force you to be contrarian in a simple, unemotional way. Taxes and mechanics deserve a realistic nod. Locking in losses can be useful for tax purposes. Selling a losing position to realize a deductible loss, then buying back after the wash sale window or into a similar security can be a smart move if you still believe in the company. That strategy turns Mr. Market's lemons into lemonade. You lower your cost basis while harvesting a tax benefit. Bonds have their own lessons. Long-term bonds swing in price with interest rates. That does not mean the issuer defaulted, but it can produce large headline losses. If you need principal stability, choose short maturities or government savings bonds. If you want yield and can tolerate price volatility, accept that the market will mark those holdings and be prepared to hold them through rate cycles. Most fundamentally, Graham asks you to control what you can: your costs, your taxes, and your behavior. Minimize fees, avoid unnecessary trading, hold for the long run to reduce tax drag, and don't check your portfolio compulsively. Daily price updates are entertainment. Over decades, they are mostly noise. The investor's edge lies in emotional discipline, using reason to exploit Mr. Market's moods rather than being swept along by them. That's the tidy paradox of this chapter. The market gives you constant, conveniently priced opportunities. It also tempts you into habits that destroy value. If you train yourself to treat Mr. Market as a vendor rather than a judge, if you insist on an independent appraisal of the businesses you own, and if you automate discipline where possible, market fluctuations become an ally instead of an enemy. The intelligent investor's job is not to beat daily headlines, it's to build a plan and live by it. Do that, and you'll let time and sensible valuation work in your favor, even when Mr. Market is having one of his bad days.